Thank you for joining us for this month's National Economic Outlook, written by Local Market Monitors founder Ingo Windsor. Ingo is a graduate of MIT and Boston University, and he's not your typical economist. He has a knack for presenting complex facts in an easily understandable way. So, without further ado, I'll turn it over to Ingo.
Thank you very much, Julie. Every month, we look at the latest economic data to see what they can tell us about real estate markets, where they are now, and where they may be headed. You make better investments when you have a better idea of the economic forces that affect supply and demand. Usually, we simply look at the numbers to see where the economy is headed. This month, however, we have to consider the extent to which short-term government policies seem to be affecting that direction. Because policies, unlike general economic forces, can change rapidly, it's much more difficult for us to make reliable predictions. First, let's look at two indicators that often affect economic changes: the cost of energy and the cost of money. Energy is used in the production and transportation of almost every product and is therefore a key driver of the cost of products. This chart shows the cost of energy as crude oil in dollars per barrel. It's high, and the green bar, the green bar on the right shows that futures markets expect it to remain high. What's most important for our analysis today is that this cost hasn't changed much in the past year and a half. Like energy, the cost of money affects the cost of most products and also investment in new production. That cost, seen here as mortgage rates, remains high even though current inflation is down around 2%. And again, the important point for understanding current economic developments is that this cost also hasn't changed for about 2 years. The reason I'm pointing out things that haven't changed is to make sure that they are not the cause of things that have changed, which we'll look at right now. We'll start with the gross domestic product, the most comprehensive view of how the economy is doing. In this picture, we see the percent change of GDP every quarter compared to the same quarter of the previous year, which allows us to see trends. The gyrations of the economy during and after the COVID epidemic are in gray. What matters is how the economy is affected by normal forces, not unusual events. And what we see in the last couple of years is a trend towards slower growth with an extra drop in the last 2 quarters. Now let's look at jobs, our best indicator of how consumers are doing. This chart shows the percent increase in jobs every month compared to the same month of the previous year. Why are jobs so important? Because the US is a consumer economy. It needs a growing number of consumers, which means it constantly needs more people and more jobs. After a surge of rehiring to replace jobs lost during the pandemic, employment growth has been slowing for years, but it looks like there's an even sharper decline in recent months. One of the reasons is the axing of jobs in the federal government. The 3% cut we see here is about 100,000 jobs. Another is the very sharp decline of hiring in the construction sector. Because interest rates have not changed, it's likely that this slowing is either due to general economic uncertainty or to the fact that many construction workers are immigrants who may be afraid of deportation. Fear of deportation may also explain the abrupt drop of hiring in home health care, one of the fastest growing parts of the healthcare sector. We might even see this effect in the manufacturing sector, where job losses have increased since the start of the year. Immigrants are a large part of the workforce in labor-intensive meat and other food processing plants. After a surge of rehiring following the pandemic, restaurants were on track to create new jobs at the typical 2% annual rate. But that growth may also be delayed by the same concerns. A lot of restaurant workers are immigrants. There can certainly be good reasons for trimming the size of the government and for stronger enforcement of immigration rules, but the side effect is a loss of consumer spending and of economic growth. It's difficult to know where new jobs will come from to replace these losses. Here's a quick rundown of the other major sectors. The finance sector is creating jobs, but at a very low 1% rate. The retail sector isn't creating any new jobs at all. Business services is usually a marker of actual business activity, but has been losing jobs for the past 2 years. The only major sector that's creating a lot of new jobs in recent years is healthcare, which is not a good long-term solution for the economy. The economy has been growing at a slower pace for many years. That's not a new problem, but policy actions from the government are likely to slow that growth even further this year. Fewer jobs and reduced consumer spending means that there will be a multi-year adjustment for overvalued assets, especially real estate. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and analysis they need with local market reports and investors' metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.